Growth stocks dominate headlines. Nvidia up 39%. Alphabet up 65%. Everyone's chasing the next AI winner. Meanwhile, value stocks sit at their lowest valuations in 20 years. Smart money is rotating now. Here's why. Hey, welcome back to lIHITRO Bank. My name is Adam. This setup could print 20% plus gains in 2026. Value stocks are companies trading below their intrinsic worth. Low price-to-earnings ratios. High dividends. Solid businesses that the market ignores because they're boring. Think healthcare companies, financial institutions, energy producers. Not sexy, not on TikTok. But historically, these stocks crush growth over long periods. Here's the current setup. The gap between growth and value stocks might be the widest it's ever been. Growth stocks have outperformed value 13 out of the last 16 years. That's historic. Between 2018 and 2024, growth beat value by nearly 9% annually. The Russell 1000 Growth Index returned 17.4% per year. The Russell 1000 Value Index? Only 8.5%. That gap is unsustainable. PIMCO just published their 2026 outlook, and they're calling for mean reversion. Value-oriented stocks remain attractively priced relative to historical averages. They see potential for substantial gains as valuations normalize. Their thesis is simple. Macro conditions favor value in the near term. Trend like U.S. economic growth should broaden earnings across sectors in 2026. The best scenario? The Fed continues cutting rates while growth reaccelerates. That's exactly what's happening right now. Look at the numbers. Growth stocks trade at forward price-to-earnings ratios of 29 times. That's 32% above their 25-year average of 22 times. Their price-to-book ratio is 13 times versus a historical average of 6. Meanwhile, value stocks trade near or below historical averages. Financials, healthcare, energy, industrials, all trading at discounts. When valuations get this stretched, reversions happen. Fast. Historical patterns support this. Nobel Prize winner Eugene Fama and Professor Kenneth French studied data from 1927 to 2019. Value stocks top growth 93% of the time on a 15-year rolling basis. 93%. During bear markets, value consistently outperforms. In 2022, when markets crashed, value easily beat growth. Coming out of the dot-com bust, value outpaced growth between 2001 and 2008. This isn't theory. It's documented history. What should wealthy investors do? Rebalance 30 to 40% of portfolios into value ETFs. VTV is the Vanguard Value ETF tracking large-cap value stocks. IWD is the iShares Russell 1000 Value ETF. Both offer broad, diversified exposure to undervalued sectors. When mean reversion hits, these funds capture the upside. Rich investors understand timing. Buy assets when they're out of favor. Sell when everyone wants them. Value is out of favor right now. For regular people without huge portfolios, buy fractional shares of individual undervalued stocks. Johnson & Johnson trades at a reasonable valuation with a 3% dividend yield. Procter & Gamble, another consumer staples giant with consistent cash flow. JP Morgan Chase in financials. These are dividend kings and aristocrats. Companies that raise dividends for decades. They're boring, they're stable, and they're cheap relative to growth stocks. Here's what's about to change. Growth stock concentration is at historic highs. 8 of the top 10 S&P 500 stocks are growth companies. 76% of the Russell 1000 Growth Index sits in just 3 sectors. Information technology alone is 49%. That's dangerous. When leadership narrows as much, diversification becomes critical. Value stocks are spread across 8 sectors with meaningful weights. Healthcare, financials, industrials, energy, utilities, materials, consumer staples, real estate. True diversification. The catalysts are lining up. Fed rate cuts support value leadership historically, especially when cuts happen without recession. Economically sensitive sectors respond to improving financial conditions. We're seeing exactly that. Value leadership typically broadens market participation. Small caps and international equities, which lag for years, start outperforming. Early signs are already visible. Large cap value relative performance reached a trough in late 2025 and has since turned higher. Easing monetary policy favors value. When the Fed cuts rates, value stocks and sectors like financials benefit from steeper yield curves. Industrials benefit from cheaper borrowing costs. Energy and materials respond to economic stabilization. These sectors were left behind during the growth-dominated decade. Now conditions favor them. Risk-reward is asymmetric. Value stocks enter this phase with lower expectations and greater valuation support. Growth stocks have high expectations priced in. Margins for disappointment are narrow. If mega-cap growth moderates even slightly, those stocks correct sharply. Value stocks? Already beaten down. Limited downside. Significant upside if conditions normalize. The rotation is starting. International value, particularly in developed markets outside the U.S., outperformed by 13% in 2025. EAFE value led all single-factor indexes. Banks restored profitability. Valuations remain attractive. Valuation spreads between value and growth sit near the top quartile of their long-term range. Whenever spreads get this wide historically, value shows modest outperformance as markets move toward fundamentals. This isn't about abandoning growth. It's about rebalancing. Growth dominated for over a decade. That cycle is maturing. Value offers better risk-adjusted returns at current valuations. 20% plus gains are realistic if mean reversion happens over 12 to 18 months. PIMCO, one of the world's largest asset managers, is positioning for this. You should pay attention. If this changed how you're thinking about your portfolio, hit that subscribe button right now. I'm covering investment strategies and market shifts that actually matter in 2026. Next week, another undervalued opportunity Wall Street is missing. Subscribe so you catch it. Thanks for watching.